Hey traders, it is Wednesday, December 11th, and it's time for our weekly live event. I hope all of you have been doing well. I hope you've been taking some profits on your swing positions. That's certainly what we've been advocating. Harry, how are you doing this week?
I am spectacular, Pete. Thanks for asking. How are you?
Things are good. Busy as always, but things are actually quite good. We got a decent market today, too. So, had favorable CPI number. I'm not sure why the really nice reaction. When I looked at the number, I thought, okay, well, it's a little hot. Well, the market rallied anyway. So we'll see how the day
Yeah,
plays out.
I was confused as well. I mean, not confused, but I saw the number, and it basically told me that inflation has been there's been no progress on inflation since July. I mean, they've made a lot of progress up until then, but it is hasn't moved since early summer. If you go back to there, to me, it doesn't exactly scream confidence or rate cuts to me, but the market right now seems to feel different.
Yeah, I mean, it's easy to push the market around too when there's no volume. So we know that
That's
everybody wants to mark their portfolios up. So let them have at it. That's why you don't short into year end. And, you don't have to be long, but you shouldn't be short. Cash is a position. So, uh, let's start off with a stinker. My last pick, Snow, is not a particularly good one. And choppy stock, you can see how the stock broke out through this compression right here. This was the live event in here. This is when I said I liked it. We did need to get through the top of that second compression here. We needed to get through this resistance level, but hey, call a spade a spade. This is not a great pick, and the stock pulled back. It is a fairly choppy stock. I did redeem myself with Tesla on Sunday, and that was in my video Sunday morning. So you can see that on Monday, the stock ran up and it had a gap reversal and it pulled back to this support level, and that's exactly what I was telling everyone was let's make sure that we are buying a dip on this. This is a fairly choppy stock. And one of the alerts that I set was an M5 HA reversal, and that triggered right here. That was your entry point, somewhere around the 383 level. And you can see the stock is at 412. So that was a gorgeous dip to buy. So redeem myself. Harry, what were you showing us last week?
I picked Oracle with the caveat sell it before earnings. I said it will run up into earnings and then absolutely make sure you sell it before earnings. Do not hold it over earnings. So last Wednesday, you had Oracle coming in. It was around 186, 187 when I called it. And then at any point, so on Friday, you could have sold that at 192. On Monday, before earnings, you could have sold that at 198. You could have taken almost an $11 gain on that trade. So if you followed that trade to the instructions, which was take Oracle, let it run up right before earnings and sell it before the earnings number, you would have taken a $10 to $11 profit on Oracle. I did not like it going into earnings, and even if I did, you don't hold these trades over earnings. That is pretty much a staple of what we teach you. So it did run up. It has a history of running up into the earnings number, and this time it did not disappoint and did exactly what I was hoping for it to do.
Yeah, that was a really nice pick. And it also demonstrates another thing that we've been doing. If you're in a shorter term swing position, bullish swing position, and you get an overnight gap like we got right here on Monday, take the money and run. The market's not doing anything. It's been really pretty dang lackluster. So you get a nice little gain like that, take it. You can always get back in, evaluate what the market's doing, evaluate what the stock is doing. And if everything lines up, you can always get back in, but that's a gift. Take it.
I have a couple of quick, easy questions here, just to maybe get them out of the way. On bullish put spreads. So, what we talk about a lot of doing when the market really is bullish is doing out of the money bullish put spreads. And what you do is you choose a strike that is going to have at least two levels of support below your short position. So, you sell the one put and then you buy the other put for credit. We recommend doing this to get 20. If you have a 20 cents per the dollar, right? So if you're selling the 100 put and you're buying the 99 put, you want to get at least a 20-cent credit there. What that does is bullish put spreads, when they're out of the money, in order for them to work, the stock has to stay above the short strike. And with those two levels of support, you're counting on that some sort of major event has to happen in order for the stock to break through both of those two levels of support. Because if you're getting a 20-cent credit to every dollar in the spread, you're risking 80 cents to get 20 cents. You're getting a 25% ROI on that. You need roughly an 80 to 83% win rate on those trades for them to work. So the question is when you close out a bullish put spread, do you close it out when you're 25%, 50%, and so on, or do you just hold them to expiration? That win rate of 83% is dependent on you getting the full credit, 20 cents. If you're taking on average 15 cents credit, right, which means now you're risking 85 cents per trade, then your win rate goes up. You need to win around 90% of the time. So, the only time I would take the profit on a bullish put spread before expiration is if it's down to a couple of pennies and there's a few days left, or you are approaching the short strike and the market is turned bearish. You're in profit, maybe not by much, and you want to close it out and you don't want to risk it. Otherwise, let them go to expiration, get the full credit on that, as it really impacts your needed win rate. And then the second question is if you have day trader status, does it mean for taxes everything is marked to market? Can your long-term holdings still have the benefit of long-term capital gains? You do not mark to market on positions. That's unrealized gains or losses. And despite popular belief, unrealized gains or losses are not taxed. So you do not mark to market your positions. You only count your realized, or what is known as your closed positions, on your total end of the year P&L. Okay, sorry, those two easy ones, just get out of the way.
I have a good question, very common question. How do you reconcile two ideas? Cut your losers and give breathing room to your trades that are running. I'm going to use an example from this morning. And I'm going to look at the S&P, which kind of puts us in that mode to discuss what's happening in the market. So, S&P context, you've got some pretty decent selling pressure that's taken place over the last 3 days since the jobs report. You have a gap up today. Gaps up are often faded. So I felt that early in the day, my best chance for a trading opportunity was to get short. Okay. I felt that's where the best odds were, and that any move higher would be much more difficult to get behind, because if that reversal happens, you're going to be left with some pretty considerable losses. So here's what happened on the open. Kind of described to everybody what I was looking for. I was looking for wham, wham, two red candles consecutively right into the gap. Okay, I can get pretty aggressive with that, because that tells me that sellers are just slapping this gap up. Silly. Didn't believe it because I didn't believe in the number. I didn't feel that the CPI justified a move higher. Also, knowing that my best odds are on a gap reversal, I waited. Didn't get the pattern I wanted, but when I saw a bearish engulfing candle off of the high, I took a position. I took a small starter position. So you don't jump right in. And by keeping your position size small initially, you're keeping your losses small. So I'm waiting for constant confirmation. So I've got a little bit of follow through here. And I told members in the chat room, okay, I will be adding if I get a fast in 2 or 3 bars breakdown below VWAP. Then I will add because I'll have technical confirmation. I would have added if I had a fast move through the open, and that would have confirmed that a gap reversal was underway. So small position, add, know your time frame, know what you want to have happen, know what that confirmation is. If I had gotten that, I'm continuing to add to the position. It's not just a matter of let your winners run. It's add to those winners. Add when you're right. That's the key. And so I didn't like the price action that I was getting in here. I was okay with it as long as we made a double top, lower high, which we did. My initial stop was at the high of the day. Okay, well, this is looking a little bit encouraging here, but I didn't like the amount of time that I had to wait for this because if sellers were aggressive, they would have knocked this thing down right away. And so now all of a sudden I'm having to wait. We've got another bounce, another test off of VWAP, and another little bounce up. This is when I took my loss, and it was 2 S&P points on a starter short position. I kept my losses small. And I also mentioned, given the fact that the market has been able to hold these gains, now all of a sudden I'm shifting into more of a long posture on a long position, and I'm expecting to see a new high of the day, which is what we got. And now we're off to the races. So scale in, know when you're right, add to the position. If you're waffling around and the market's not giving you what you want, you can stick with that small starter position, but know when you're wrong and when you need to get out. That's
Let
that's
me
how you control it.
let me talk about a little bit about the mindset part of that question. Let's break it also up into three different types of trades, right? You have your momentum trade, you have your regular day trade, and then you have your swing trade. Momentum trades are going to fuck you up, right? Mentally, they're just going to mess with your head. And the reason they mess with your head is on taking profits, letting it run or holding those losers. Is let's say you have a $10 stock, right? And these momentum stocks are usually these cheap little stocks you never heard of, stupid companies, low float, whatever. And all of a sudden, it's up $4 on the day. So the thing's up, it's a 14, right? It's running. The thing's going crazy up 40%. You want to get in on it. You've certainly seen plenty of examples of these $10 stocks, and all of a sudden they run up to $30 by the end of the day. And you're like, this is it. I'm going to do a two bagger on this. This is, great. So you go long, 14. And lo and behold, it drops. And it drops down to 11, right? So now you're like, okay, I'm going to get out, take the $3 loss, because at this point you're no longer using support and resistance levels on these momentum stocks because by definition they're blowing through these support and resistance levels. So you have to understand on your trade you're no longer dealing with the technicals. You no longer have these set locked in points, and the stock drops. But you're thinking, well, this thing is going to jump. This thing, it's a momentum stock. So if I get out at 11 and it jumps up to 16, I'm going to miss it. So what a lot of people do is they average down here. All right, now they have an average cost of like 12.50, and now they're hoping for it to jump. But you have no rules. You have nothing there to help you decide when to get out and when not to get out. You're going basically off pure emotion. So the first rule there on taking losses and gains is the moment your decisions are based on raw emotion, it's not a good position for you to be in, right? You have no guardrails. Now, when you're looking at your day trades, the difference on the day trades and the swing trades is just really where your support and resistance levels are. And so it's really where your tolerance levels are. If you're looking at a day trade, your tolerance level of getting out of that long that you took might be VWAP, right? It might be intraday VWAP. It goes down, it tests VWAP, it breaks through it, and it's below VWAP right now. That might be your tolerance level. Whereas if you're intending to swing something, right, you have a swing trade on, you took Amazon or whatever, it might not be VWAP anymore. Now it could be your SMA, right? Now you're looking or trend line, and so that becomes your level. And what it really comes down to is not only knowing where those levels are, knowing if you take a swing trade and it's a $200 stock and that support level's down $5 below where you took it, are you willing to accept and hold it through a $5 drop to see if it bounces off that support? That's your position size, right? What position size has it become uncomfortable for you to hold that? And if it continues to confirm and you're in profit, Pete's absolutely right. The number one thing a successful trader does is add to their winners, right? So you just keep adding, and yes, it averages up your entry, but as long as the stock continues to confirm, and this is important, the market is behind you, there's no reason not to add, right? It's sort of like, if let's say you bet on a sport team to win and you make a bet with someone and it's the fourth inning or it's halftime or whatever, and your team is winning, right? You're winning the bet. And the person you made a bet with says, "Hey, would you like to double that bet right now?" Well, you're already winning the bet. You would take that every day, right? Let's say you bet $50 and they said, "Oh, let's make it 100," and your team is up 21-10 at halftime. You're going to say, "Yeah, okay, let's make it 100." You're already winning, right? But when it comes to stocks, people don't do that, and that's kind of where you have to put your mindset and your thinking on adding to winners.
Here's a little small cap stock. I figured while you were doing this, I was going to try and find an example of a Momo stock. SFIX, Sam Frank Ida X ray. That's a nice little stock. Actually, I went through and found quite a few little stocks. Option Stalker Pro, this custom search is incredible. So I'll just put up some of the, if this is what you like trading, 52-week high, RVOL greater than 3 times normal, the average daily volume, stock price between $5 and $10. You can throw a bunch of different variables in there, but you're going to be able to find some of these lower price stocks that are breaking out. So the issue also with Momo stocks is that the only reason that they're on your radar is because they've made a huge freaking move. Okay, so already right out of the gate, you're thinking FOMO. I don't want to FOMO into this thing. Look at how high it's gone. But if everything lines up, the only way that you can take a position is to take a very small starter position and to add when you have confirmation on it. So SFIX would have given you that confirmation along the way. Keep adding. And now, yes, even though your average cost is rising, it's still well below the price of the stock. Okay, so you can just look at VWAP. That's basically what VWAP is doing. It's like dollar cost averaging on the way up. And as long as the stock continues to go up, look where your cost basis is way down here. At worst, when it comes back to it, you would be able to exit for a scratch. And that's what gives you the confidence to keep adding to the position because it's continuing to perform. And now you're not going to wait for it to come back to VWAP, but mentally, that's what you're telling yourself is, wow, I got a lot of cushion in this and I can add to it without worry because I can put my stop way up here and still make a lot of money because I have a big position on now. And the stock's not herky jerky all over the place, it's grinding.
Got a question here. By the way, I think there was news on SFX as well. I'm not sure what it was, but there was news on that, and I
I think I
certainly
got
don't
a new
know.
line of pants, a new
Well,
Christmas line of pants.
yeah, probably.
I don't know.
I mean, look, that's exactly what you wanted. I mean, this thing popped right out, and if you had an alert set on this thing, where would it be? It would be at like 490 or something. That alert would have popped this morning, and you'd had yourself a nice trade. And the long-term trend on that certainly looks good. It broke through every possible trend line. Really nice.
Oh, it looks like it had earnings after the close yesterday. That's what it is.
Ah, I see. Yep, yep.
They're selling lots of pants and
There
whatever
it
they
is.
do.
Um, A lot of you aren't looking at the daily chart. I can tell from your questions here. It literally needs to be the first chart you look at. So, for example, someone asks, what do I think of BHC? Well, if you go to BHC, you will see one, it failed to get through the 50 SMA since November 19th. It tried several times, it couldn't. Today, it broke down and broke below the 200 SMA, but bam, stops almost exactly at $7.40, which is 741 was the low today, $7.40 is the SMA 100, and bounces off of that. So now you have something that's just basically bouncing around between the three SMAs. It hasn't broken above the SMA 50 or below the SMA 100. Until it does that, there's absolutely no trade here. There's nothing you do with this stock. So if you look at just a quick glance at the daily chart that has the 50, 100, and 200 SMAs on it, would tell you this is a no trade stock. Same thing here. I'm getting a lot of questions. Everyone knows I am short at the moment. NVIDIA. Why am I short NVIDIA? Well, I've been short NVIDIA for a while, and I originally was short NVIDIA as a hedge, right? Then when I closed my long positions, I was like, all right, I don't need the hedge anymore. But lo and behold, there goes NVIDIA. It falls below the 50 SMA. And now the 50 SMA, which is at 138.94, it remains below it. How do I do that trade? That trade's simple. If it closes above the 50 SMA, I close the trade, I'll take the loss. It started out as a hedge. I'm fine taking a loss on a hedge trade. However, if it closes below the 50 SMA, I'm holding the short. Just one look at the daily chart tells you everything you need to know about why I'm in that trade. Tells you everything you need to know about why you shouldn't trade BHC. If you are not looking at the daily chart, and yes, I'm including day trading in this as well, you are not doing it correctly. The daily chart will give you your best indications of where support and resistance is. And that is the support and resistance used not by idiots like all of us who are retail traders, but by institutions. And institutions are who moves the stock. Institutions look at the 50 SMA, the 100 SMA, the 200 SMA. Their buy orders are lined up around those areas. So I can see the whole idea behind everything we teach here is institutions are going to beat retail. If you follow institutions, you will do well. Get the crumbs from the table. How do we follow institutions? Price action. Price action will tell you what institutions are doing. It's kind of a map as to what they are doing on any given day. You can look and see, oh, institutions are there, not there. Look at the volume, look at the price action, look at support and resistance levels, and look at relative strength against the market. In order for a stock like NVIDIA, Amazon, any of these stocks really to have relative strength against the market or relative weakness against the market, you need institutional volume. You need institutions buying or selling that stock in a higher proportion than what they would normally do based on what the market is doing. That is why the daily chart is crucial to your trading. So I'm looking at these questions and it tells me you're not looking at the daily chart. And if you're not looking at the daily chart, you are not trading correctly.
Why would I trade a short on BAH? Well, I mean, the stock is right down on a major horizontal trend line. So I wouldn't be getting short here. If you were short on this resistance level here and its inability to get back to the 200-day moving average, you had an opportunity in here to maybe enter a little bit, but I wouldn't be adding unless you get a nice solid breakdown today. It's testing this trend line. Take a look at the 5-minute and you can see how the stock has been in a steady drift lower, decent volume picking up in here. So I think the stock looks weak to me, but you've got to see it crack through that line today. It's got relative weakness when the market is up. So overall, I'd have to say I think this is probably going to be a pretty decent short, but you've got some major horizontal support levels coming into play right here. So I would be very watchful of those.
Someone asked, thanks for explaining bullish put spreads. You have recommended buying a Bros call spread. That was the previous week or 2 weeks ago, I believe. So I don't think that any longer applies, although I still like the Bros chart, just not as much as I did. It is bouncing off the EMA 15. Would you hold call spreads to expiration as well? No, I never hold call debit spreads to expiration. The idea behind a call debit spread is I get the move I'm looking for. I go in with a max loss of, let's say, $1.90 on a $5 spread, um, and then I could sell it for $2.80 or something, whatever, make 90 cents on it. I'm not looking to hold that. The only time you look to hold that is, let's say you do a call debit spread. You buy the 200 call, you sell the 205 call, right? You got that $5 spread there. And you did that for $2, right? So you're risking $2 and you can make three. And the stock jumps up. Let's say you did it on Crowd. Someone talked about Crowd, and the stock, which would be a 355, 350, let's say to 355, and the stock jumps up $20, $15, and it's so far above your short strike. Well, at that point, unless and it's Thursday, well, fine, okay, just hold it to expiration then, and you'll get the full amount of credit on the spread, right? That's sort of where I would do it. But normally, we day trade those or maybe hold them overnight, and use it to mitigate the price of the at the money call or the at the money put. It's sort of it's not like a bullish put spread. You don't need to maximize your win rate odds by holding those positions. And by the way, take a look at Nvidia right now. I'm not saying it's not going to break through, and if it does, once again, totally happy. Not happy, suck, but I'll close it for a loss. But unable to get through that SMA right now, bouncing down off of it.
The other thing about spreads is, and just in general with trading, okay, you're always looking for lots of upside potential, very limited downside potential. And that's why when we take a long position, for instance, we don't want to be buying a stock that's going to be bumping up against the 100-day moving average, bumping up against the major trend line. Okay. Our upside to that trade is very limited. When you've been in a spread and you buy it for $2 and it's trading at $4.50 and it can go to $5, you've maximized almost everything that you can make out of that spread. So your upside is very limited, but your downside is big because something could happen and the stock pulls back and now you're stuck with a loser. So that risk reward ratio should always be there. And if you've already gotten the full benefit out of the trade, exit, take your
Yeah.
gains, don't try and milk every last penny out of it. The same thing has been holding true for the market. I've told everybody Thursday, you should take a third of your swing trades off. Friday, here's what I'm looking for out of the jobs report. No matter how this plays out, you should take a third of your positions off. Now you still got a third of your bullish swing positions on into year end. We had a pullback. Anybody that didn't take that advice is feeling pretty crappy the first 3 days of this week. Okay, now everything's back, but you're thinking, gosh, I should have taken those gains when I had them, and I missed that opportunity. So, you're not trying to get out at the absolute top. You're not trying to pick the absolute bottom. You're trying to take a big chunk right out of the middle. And when you have an entry and price confirmation, you add, you add, you add, and you do the same thing on the way out. Is when you sense that you're getting near that target and you start scaling out of the position. You're watching price action to tell you when you're getting close to that resistance level.
Two quick questions here. One, which might actually be my pick of the week. But first, back on Crowd, learning in the paper trade phase, just added to Crowd, average 359.28 on relative strength. How can I gauge an exit based on technicals? Put up the Crowd daily chart. First thing you want to do is draw a line from the bottom of 11.6. Connect that line to the bottom of 12.2. Connect that line to the bottom of 12.10 and then to the bottom of today. That gives you your bottom end of that wedge. Then connect a line from the top of 11.25. Connect it again to the top of 12.5. Cuts through again on 12.6. Connect it to the top of 12.9 and then to the top of today. Now you have a perfect wedge here. You have a very narrow band here on your support and resistance. It breaks through the top end of that line. Well, now you can add again. It breaks through the hits the bottom. It breaks through the bottom end of that line. Get the hell out of the trade. So there you have your very easy to do trend lines to decide where's your support and resistance on a stock like Crowd, and don't forget where the all-time high is on that, which is around 397. But my pick of the week, which Demos asked about, and well, I'm not sure it's my pick of the week yet, but I really do like it. Urban, RUBNP. I like this stock. Now, there's a bit of a compression here to watch out for, but you get this, what I'm assuming is an earnings gap up on 1127, and the thing just keeps going, right? And then it starts to consolidate up through December 5th. Takes a bit of a dip down. You get some sellers in here and it holds, but then it doesn't really go, it only goes down to like 49. And then today, right back up again. I like this stock. It's not too extended. It's holding its gains. The gap is far away. You have what right now a nice bull flag. I would, and also you have a very clear exit on that trade, which is 49. Right, that is the bottom of that compression. For it's actually 48.80. So you put your alert or a line there at 48.80. That's where you exit if it falls below that. But other than that, this is a stock that not only I think could be a good long, but if it breaks through 52.68, which is the high on December 4th, that is where you can start to add. That is where you can see it broke through compression and you can add to that trade. So I'm kind of even talking myself into Urban more and more. This could be my pick of the week.
Okay. I don't know what my pick of the week is. In fact, I'm even leery to give you one because I think the market's just going to be trapped in a range. And I think you're kind of in a mode where you're forcing trades at this juncture. We got the FOMC next Wednesday when we do our live event. So we'll see what the Fed has to say. But let's see. I got a couple of stocks in mind. I mean, there are some really big mega cap tech stocks that are running, the Apples, Metas, Google. They're all running into year end. Tesla. So they all look good right now. I don't know that I would be chasing anything into year end, though. A little bit of a market pullback here, too. I'm watching this. So you get a nice long green candle to the high of the day, and you've got this persistent nagging little drift lower in here. This was not a particularly strong rally. We had mixed overlapping candles in here. So we'll see what happens. We'll see what happens with this little move in here. I don't know that I'd be shorting it, but just an observation right now. Matt asks us, hey, any advice for paper trading? I'm in the UK and UKX has been in a range since May. Yes, my advice is keep looking. My God, there are 5,000 stocks out there and they're all moving. You are locked into something that is in a horizontal trading range. You should never trade something like that. You have to have a stock that's got a trend to it that has a pulse to it. Then you've got something to hone your skills on.
And keep in mind, by the way, paper trading is, and I recommend it, it's part of the step process in the wiki that, but the only way paper trading works is if you treat it like it's real money. If you start a paper trading account with $1 million and you're like, oh, I'm going to buy 50,000 shares of NVIDIA and this, you're not helping yourself. You're playing a game, right? You know, if you're thinking, all right, my goal at the end of this is I'm going to deposit $10,000 into this account and trade that. That's what I have. Then start your paper trading account with $10,000, like, and trade it as if it were real. Trade it as if that's how you would trade it, because only then, when you hit those benchmarks, right? You don't want to be hitting benchmarks that were based off of luck. You want to be hitting benchmarks based on how you would actually trade. So just wrap your head around the idea that that's how you need to trade those. What do I think of an Adobe Strangle? The previous earnings, the stock did a significant move to the upside and downside. Well, the good news is that Option Stalker does tell you what percent of the time that stock exceeds its earning projections. And for Adobe, it's 33%. What does that mean? It means 66% of the time it comes within the range that the market makers are giving it. And right now, the market makers are giving Adobe a $45 range, right? So that's about a 7 to 8% move on the stock. A strangle on this, right, or even a straddle, you're paying around 130% IV on that. That means this stock needs to move more than $45 in either direction for you to be right. Can Adobe do that? Of course it can. 33% of the time it will. 66% of the time it won't. So your better bet is to do a time spread. But even on a time spread, you need a stock to be not exceed its earnings around 20% or less. So it's not good for a time spread. It's not really good for a strangle. I would hold off on it. With that said, watch Adobe will move $100 tonight off of earnings, and everyone will be like, "Oh Jesus, you should have taken a strangle." Yeah, it could, but that does not. Exception doesn't prove the rule. It's a dangerous trade to take. That's all I'll say about that.
It's all about the odds. Okay.
Yep.
It really is. Every decision comes down to the odds. In general, if you are buying options uh, into earnings, you are going to be a loser because you are going to have to get the direction right and you are going to be faced with a huge volatility crush. Harry has traded earnings, but for the most part, he's used the underlying stock or very deep options, and he does fundamental research. I've tried to trade earnings, and my net result overall was I probably would make money 55% of my trades or so. Why would I waste time on that when I can hit 80, 85, 90% on my other trades? It doesn't make sense for me to do it. So I don't ever trade earnings.
Yeah, I mean, we all get it. It's not like Pete and I don't get it, don't get the allure of it. It's a scratch off lottery ticket. When you trade, you're mentally in the mindset of I want big moves, right? I'm going long. I want to see a huge move up. I went short. I want to see a huge move down. And what gives big moves? Nothing gives a bigger move than an earnings, right? Earnings give the biggest move for each stock, and they happen 4 times a year. So you want to get in on that. And then there's all this FOMO. You see a stock and you think, oh man, it just went up $50. And if I was long that, but in the long run, unless you know how to really read the fundamental research, unless you have access to the type of research that, for example, I have access to, and that's why the only reasons I post earning trades and I don't do them in the OneOption chat room, I post them on Twitter, and I haven't done one, by the way, this whole past quarter. I haven't done a single earnings trade is because I would have access to that research. I did not believe in much of what they were saying this quarter, and it's a good thing I didn't. I would have been a loser had I traded earnings this quarter. Just straight trading since November 1st, my win rate is 90%, and I haven't taken a loss since November 13th or something like that. So I'd rather, as Pete said, do that than mess around with earnings all day. There's no point to it.
AXON. I've got a question on that. AXON. Let's take a look at that stock. How would I trade it? What do we think? Is it a swing long? Well, you do have some profit taking right in here. You can see how it's come back and it's testing this AVWAP-E line right here. So AVWAP-E, it's an indicator that I use. It's the VWAP anchored to the earnings announcement date. And it has been able to hold that level right now. I would hope to see a little bit better price action out of it when you get the market doing this, gapping up and continuing to go higher. And the stock still has not been able to get above the EMA 8 or half of this long red candle here. If it could start working its way back there, then I might consider it for a long. The stock looks good. I mean, this is a nice bullish chart here. It's made a big move, so looks pretty decent. This would be your stop is at AVWAP-E and that low from that long red candle. You don't want to get below that because then there's a chance that you start retracing that and perhaps even getting into the gap. But it looks pretty good. I mean, I think that's a nice stock. It's certainly one to have on your radar.
Keep in mind the low volume on this stock. Keep in mind that it's a low float stock. 70 million shares are out there available. It's an expensive. It's also an expensive stock. So if you were to trade it, you probably are trading options, and it only has monthly options. So that's another thing you have to consider if you're buying the options on it. You're buying a monthly option on this. You'd got to go to December 20th or all the way out to January 17th. And also, when I look at the chart of this, I see earnings moves and then very small candles. Earnings moves, very small candles. So, just keep in mind that, your ATR is a little bit skewed because of those earnings moves. And then the reality of the ATR is really that it's a little bit more, tighter range on the stock. But there's no doubt it's a very bullish chart. What do I think of UNH stock? Well, I think they clearly are news impacted by the fact that their CEO got murdered, and that has dropped it. My hesitation here. Look, if I took away the name and I just looked at the stock, I'd be like, oh, this is a pretty bearish daily chart. It broke through the 50, it broke through the 100, and now it broke through the 200 SMA. That's just it's reflecting uncertainty, right? There's uncertainty there. The moment there becomes some certainty in the corporate structure, a new CEO comes in, things settle down, you probably will see this recovered. When is that news going to happen? When will they announce that? Could be today, could be tomorrow. You don't know. So it's a very dangerous stock to trade, simply because it is right now just reacting to the uncertainty of what happened, and not because of anything fundamental with the company. So when a CEO gets replaced, it could pop back up. So just be careful. If you're looking to day trade this short, that's one thing. You use VWAP, VWAP's your stop, weird rhyme, and there you go. But if you're looking, absolutely would not swing this stock.
Here's how I look at it. I look at that chart. I have traded UNH before. I take one look at that chart. No, thank you. This to me is complete trash. Okay. Wouldn't touch it with a 10-foot pole. Look at this choppy ass price action back and forth. Oh, great. We have a beautiful breakout here. Oh, this looks fantastic. Woof. Bottom falls out. Crap. Where'd that come from? It's a $650 stock. Well, 537 now. No, there is nothing I want to do but avoid stocks like this. Let's put up a better stock. Let's put up Tesla, which was one of my picks from last week. I could go through a bunch of, this is what I want. That's the price action I want. Netflix, okay, let's put that one up. That's what I want. This is what I want. That choppy ass back and forth. Folks, please, if you don't learn anything else from me, avoid that crap. Okay? There's no way for you to predict the flight of a bat. This is geese in V formation, and it's winter, so they're flying south. I can predict where that stock is going. Okay? I'm getting a little bit heated about this, but geez, you might be new to our live event, but if you take anything away from this live event, that's what you should take away. This is the pattern. Nice, tight, orderly. It cannot get smacked down because institutions are buying, 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 buying. Every time a seller comes in, that bid is strong and that stock is gobbled up because they are not thinking about next week or next month. They are buying this for 3 years out. So, rant over. No, I don't like UNH. I don't like any stock that looks remotely like that.
There you go. So that's how Pete feels. I have a paper trading phase. I'm in paper trading phase. There are 8,500 planned for trading. My broker charges $3 to $4 per trade, and that eats up my day trade profit. How should I approach this? Well, one, a flat fee commission, it works well when you're trading size, right? If you're trading a lot of shares or a lot of contracts, then a flat fee of $3 to $4 is great. However, if you're not trading size and you're trading one option contract or you're trading 100 shares, then you want it to be a commission that is per contract per share, right? You're looking at 25 cents a contract or 1 cent a share or something like that. And that's if your broker can't negotiate that, you can always call your broker and try to negotiate the commissions. They will negotiate with you. Almost all of them will. If you can't get them to do a per contract or per share trade, then I would consider changing brokers. Go to America, go to Schwab or something to do your trading. If or even Tradier, um, if that's the case. But if you're doing a flat fee commission, then that only really works if you have size. How's the challenge going? Look, it's flat, it's even right now. I actually haven't traded the challenge account in about a month. I've been distracted doing a million things. I promise, absolutely promise, I will get back on it. I apologize for that. I'm going to put up my journal for all my trades that I've done since November 1st soon as well. So you'll have all that. But as always, everything is posted live, every trade size, all of that, all verified time and sales, blah, blah, blah. So you have all of it. Okay. Could Pete please explain why he uses the EMA 8 and how? I use the 15, you use the 8.
Maybe we should divide that in half. Go with like the 11 and a half.
Yeah, let's use that. Let's
Like
use the
that.
11 and a half.
Okay. All right.
It
I'm
would be
in.
just as effective.
I don't know. It just look at Netflix. It seems to work pretty well, wouldn't you say? I mean, I think everybody gets used to kind of their own tool sets, and one person likes one, the other one likes the other, and EMA 8 is very widely used, and EMA 15 is also widely used. So is the SMA 20 and the 50, the 100, the 200. So uh, it's what I'm comfortable with. That's why I use it.
Yeah, I mean, look, there are indicators that are just fact-based indicators. Right? An EMA, an SMA, these are just moving averages. The EMA is a weighted average, right? So it's going to weight more towards the current day, and the SMA is just a simple moving average. Literally, that's what it means. And so you look at it to see the trend. This is the average price over the last 50 days on the SMA 50. Where's the price now? Oh, it's above the average price. The trend has been going up. When you're looking at an EMA, you're looking at a more compressed average price range. So, I'm looking at it over the past 2 weeks. Pete's looking at it over the past week. How is it comparing to that trend? Stocks tend to use that as sort of a mini support, mini resistance levels. The 8 and the 15 are pretty much the two most widely used ones. To me, they're interchangeable. You can use both as long, if you have an EMA there, and Pete made a very, what he just said was he looks at the chart and it works. Okay, it's bouncing off. It's not. If you have an EMA and the price range does not seem to respect that EMA, and you're looking at the EMA 34 or whatever, then don't use that EMA. Use one that the price action confirms actually works as mini support and resistance. If it's not confirming that, then just don't use it. I mean, it's as simple as that.
Experiment with it. Find out what works for you. And when it comes to EMA, for me personally, it's really assessing how far the stock has moved and how quickly. And so it's more responsive than the 15. I don't use it as an absolute when I'm doing a trade, but I use it more for kind of confirmation. The major moving averages are really what I use. AVWAP E is what I use. For S&P, I use AVWAP Q. Those are relevant to me, okay? Much more so than the EMA 8, because you'll see that on these exponential moving averages, and here you're bumping up against it. You're crossing over, you're crossing below it. It's just a way of getting a general idea of where the stock is. And in here, you can see how Netflix is distancing itself from that EMA 8. That tells me I'm going to be chasing if I'm in here, and I should wait for a pullback to it if I'm considering a long. Oh, there we go. All right, this would be a good entry point. I have a question. Good question. Let's see. Harry, you've said Pete's been an influence on you when it comes to trading. Who does Pete look up to, and who has influenced his trading? Uh, I've had a couple of people that influenced my trading when I was on the brokerage side of the business. I got to observe how they traded. I had one customer who was a freaking monster. He was a whale, and we wouldn't hear from him but a couple times a year. And when he came in, God, he was huge and he was right. And so he was one of those guys when he did a trade, it was like, oh, what's Joe doing? And that told me that you don't have to trade often. You just have to be really good at identifying big windows of opportunity. And for instance, last November, I was jumping up on the table, pounding my fist on it, telling all of you we got a huge buying opportunity coming up. So get ready and freaking ride this pony for a very long time. And it was the type of setup that I felt really favored our odds and it favored a very long term move. And it's because we had sold off after 2022. So there were decent valuations, blah, blah, blah. There were many reasons why I felt that that was going to be a good opportunity. So that's the lesson that I learned from that. I just got off the phone with someone else that's had a big influence on me, Larry McMillan. Larry and I have spoken at many conferences. We're really good friends. And the main thing that I've learned from Larry, obviously, he's got the book Options as a Strategic Investment, best options book ever written, 300,000 copies sold for good reason. Um, so the mechanics and the strategies I learned from Larry, but that has really nothing to do with trading. It doesn't teach you how to become a good trader. So Larry and I would speak at lots of conferences together, and I would always listen to his speeches because Larry is very creative, and Larry would find seams within the market. He would find edges, and he would research them, and then he would devise a trading system around them. So I always was intrigued by what he was able to find and how he was able to define a rule base around that edge. I don't trade anything that Larry trades. Okay. So our methodologies are different, but that same process I was able to employ when I was trying to develop my system. And so there was a big influence that way. But what I've learned, I'm sorry to say, I did not learn it from any damn book. I learned it from my trade journals, and I kept very detailed trade journals every day, and I reviewed them on the weekends, and I corrected what I thought I could improve on. I found puzzle pieces that made sense to me, and eventually, over time, I was able to group those pieces together. And then even further over time, some of those big pieces and groups of pieces I was able to connect until finally I had a trading system. And then it was a matter of refinement. But it's a very long process. I wish I had what I have now when I started, because it would have cut 5 years off of my learning
Only
curve.
I knew back then what I know now.
Yes, sir.
Uh, EMA 3 and 8 are very popular in the M5. What about the D1? I'm talking about, we're talking about the D1 here. I don't use the EMA on the M5. I know there's a 3-8 cross bullshit and all that. Yeah, I don't need to look at a 3-8 cross to look at the M5 and see where the trend of a stock is going. So no, I don't use any of those on the intraday chart. Um, what do I think of Intel? I think it's a crap company. I think it's a crap chart, and I wouldn't touch it. Um, the same person who posted Urban, I'll post another good one. Demos again coming through with Asan. I like Asan. On this one here, I wouldn't take it just yet, although I could certainly see why one would. I would simply put an alert right there at the top of 1210's price action at 2610. It breaks through 2610. I would take Asan all day long. So another nice pick. Just put an alert at the top of that compression And if it breaks through, don't hesitate and take us on. What do you think of us on there, Pete?
It is a very big breakout, big volume. Definitely looks like the buyers are very aggressive and wanting to own more of it. I'm looking back. There does seem to be some longer term horizontal resistance, kind of at the point that you had mentioned, which is pretty much the high, the high from today. So yeah, that's why it's not able to get through that right now in the first try. So uh, it's okay. I'm not a super fan of it just because it has pulled back dramatically since its high November 8th of 2021. It spent a long time finding that base, and it's just now starting to regain its sea legs. So I need to see it get through this level, and then I need to see some follow through. If you wanted to take a small starter on a breakout, that's cool, but it's got to keep moving higher for me to get the confirmation I want to add to the position.
Um, Me Channel says, would it be possible for Harry and Pete to do educational video, teach folks essential things such as AV, WAP, EMA 815, etc., and how to correctly use them? We do. We have those videos. Look at Pete's site. Look at my YouTube channel. We have videos on how to use his technicals. But if maybe we can put together a video on just sort of the fundamentals, what we each have on a clean video of this is what we have on our charts. This is how we use them. We could consider that, but the information is certainly there. Here's a
You want to see
question.
what I got on? Want to see what I got on my chart? Right here. This is what I got on my chart.
Yeah,
Every week you see this, it's the same. So I've got our automated trend lines. I got the 100, 200, 50-day moving average. I got AVWAP-E. I've got our buy and sell trade signals. I've got historical implied volatility for the options. So I know if I'm inclined to be a buyer or a seller of options. And then I've got relative strength. I've got volume and RVol. So that's all I have on my charts.
there you go, and it pretty much mimics mine. Here's a question we get a lot. Days where stocks with relative strength start strong and then fade. Markets continue to climb, but the stock that was very strong for the first circa hour of the day, good chart too, and other days where it won't stop. What's the difference? Or how can you better tell if it's going to keep going or fade? Um, Look, you see the relative strength right early in the morning. You see, okay, this stock is starting off strong. So institutions are in there buying. It doesn't continue. Rarely will you see it continue nonstop throughout the day, right? So let's take a look here at uh, Google, right? Google might be another good pick, by the way, and Google might be my other pick of the week. You have Google, which recently just said, hey, there's a multiverse out there, otherwise there's no way this damn chip could have solved this thing in a faster time than would normally take a supercomputer longer than the age of the universe to do. But of course it can only solve one thing, so there's no practical application yet. But Google starts off the day incredibly strong, but then it levels off. It levels off at around 7:15 after the first 45 minutes, and it starts to drop, and it tests VWAP down here, and then it starts to power up again. Now, what you do is you wait, you see that first pop, you see that compression, you see the tested VWAP, you see it break up, and then when you take Google, you take it right at 9:15. You take it, or let's say even 9:20. You take it when you see it break the top of that compression, the top of the 710 candle, and you go in there. So that's what you do. You don't jump in on it right away. You wait to see, is this going to test VWAP? Is it going to bounce off? And this is a perfect example of a stock that bounces right off of VWAP on the intraday, heads back up with more relative strength again, and now continues up again. So that's how I would play a stock like that is, that's why we wait an hour. I usually wait an hour. I don't jump in. Am I going to miss the ones that just keep on going? Sure. But I'd rather wait and see if a stock stops, retraces, tests that VWAP, heads back up, and then it's off to the races for the stock again. Google actually might be I know I said urban. I like urban, but if you're looking for a bigger play or a bigger stock, I really like the breakout here on Google.
I like that one a lot better than urban.
Yes.
I like the Google breakout. So a couple of other things is that number one, Harry mentioned, hey, there's news on Google. Oh, there is? So you get a market that's gapping up. Everything's going to gap up. The shitty stocks are going to gap up, and so are the good ones. So sometimes you're going to see a little technical breakout on a stock that gets through, let's say, a 50-day moving average. Oh, wow, the volume looks pretty good too. It's got relative strength. I think I'm going to buy it. Well, if the market reverses that gap up, you're going to be stuck. Even if the market continues to go higher, there's a good chance that that little move in the stock was just technically based because it got through the 50-day moving average temporarily, and whoop, it falls right back down. It didn't have the news, and it didn't have the volume and the technicals on a D1 basis to justify a move that was going to continue to grind higher. But Google, on the other hand, had this gorgeous D1 breakout through horizontal resistance, through a downward sloping H minus trend line. It had everything. It had the volume. Okay. Big volume. Do you want to chase this? You don't really need to. Like Harry said, wait for the dip, right click, create alert, M5, select above VWAP, add that, and you could add another condition, which would be real relative strength M5. Now I have to have both. And yes, it's telling me you have both right now. So as the stock is pulling back, the stock is weak relative to the market. You're not going to get the alert. Oh, here we go. It's below VWAP and now it's above it. Now it's just waiting for that relative strength. You're going to get your alert in here and you've got very nice upside to the trade. So that's how you trade it. You cannot expect that this type of relative strength that you got early in the day on a massive move for this stock. That's a big move. A $10 move in Google, it's huge. You cannot expect this relative strength and this type of move to continue into perpetuity. It's not going to 500 today, okay? At some point, it's going to lose its strength relative to the market. So you can't just look at relative strength, but you always should look at the D1 relative strength because that's a daily chart and that doesn't move that much. On a 5-minute basis, you've got movement above and below zero all the time for relative strength.
Question here I got to address from Rozazinski: is trading even possible? My God. All right. First, let's start with an analogy: poker, right? You can play poker and you can gamble, right? You watched it on TV, see people that you play, you gamble, you lose. 95% of people do that. But you also see people that play poker professionally, right? They pay their bills doing it. They grind every day and they do it and they pay their bills. You also see people that are extremely successful playing poker. They're constantly at the final table in every tournament. That is not, there's no luck there, right? I mean, it's statistically impossible for Phil Ivey to continuously make that kind of money year after year after year, unless there was skill involved. So you look at that and you say, okay, it's possible to be a professional poker player. That doesn't mean it's probable. It doesn't mean you can do it, right? It doesn't mean you're able to do it. It just means that it's possible to do it. It means that there is more than luck involved. When you say something possible, what you're really asking is there more than luck involved in this endeavor, right? Is there a skill involved? And by skill, meaning, is there a way for my odds to go more than 50%? That is why for the past 2 years, over 900 trades, I have posted every single trade I have made publicly. I posted the entry, I posted the price, whether it's an option or a stock. I posted the exact position side, and I posted the exits, every winner or loser. And you can go back to my Twitter account. You can look in the OneOption chat room, whatever it is, it's all right there, and add it up and see I have not only beaten the market consistently every single quarter, but demolished the market consistently every quarter. What does that mean? It means that would have I been better off just putting my money into SPY or QQQ and leaving it there? No, I would not have, because my win rate 2 years ago was like 80, my ROI was like 90%. And the year after that, it was like 85%. That's the return on investment. So not only are we just saying trading is possible, we're proving it's possible. That's why every week we give our picks. If you go back to when we started doing this, our win rate on our picks here are 85, 90%. 8 out of 9, 8 out of 10 times, we are 9 out of 10 times the picks we're giving you. If you had taken them and closed them the following, you would have made money. So is it possible? Yes. Why? Because there is skill involved. It takes a long time to learn that skill. It is an easy thing to learn the rules, just like chess, just like poker. You can understand the rules of it within a day, within a couple of hours. But to master it, to do it, takes time. People don't want to wait. People don't want to put in the effort. It's like going to graduate school. It takes a long time to get that degree before you'll ever see a return on your investment. Put in the 2 years of time, not waiting, not expecting a return. At the end of it, then you start actually trading real money. Yes, then it's possible. Is it possible just to put money in your account and get going? No, no, it is not possible then.
Any
Oh,
insight on RDDT? Price action's kind of erratic and I'm kind of wanting to hang on to it, but I don't know. Well, if you don't know, then get out. That's my advice to you. I've told all of you, I'm buying this thing and I'm not looking at it for 5 years unless I might decide that I want to add to it. So if your time frame is different, for anyone that's swing trading on a short-term basis, and again, I talk in a 3-month time horizon and shorter. Okay. That's the longest I want to hang on to anything. Yes, I've got investments. Okay. So investments, I salt them away. I don't even look at that crap, quite honestly. Shorter term, there are moments when you have to be in and out of the market. And right now, I see the upside potential as being very limited versus downside risk. So I am reducing my positions, period. I don't care if it's Tesla or Reddit or uh, APP. I'm going to the sidelines, folks, okay? Because I'm not comfortable with what the market is doing. And I am not going to think twice about my decision. If the S&P goes to 7,000, I don't care, okay? I'm out. I'm happy with what I've made. I don't like what I see forming. The price action is telling me that this is a time to be prudent and to take gains. That's it. If you feel differently and you have a good track record, then you should by all means act on what you see. So you don't like Reddit? Cool. Get out. Take your gains. It's been a nice trade. How can you argue with that? That's beautiful. Yeah, it's a little choppy, a little chunky, but looks good to me. You ask me where this stock is going to be 5 years from now. I will bet you almost anything it's going to be higher than $168. So I'm going to just hang on to it and let it do what it's going to do in the meantime.
Someone asked about ASML, and this is a perfect stock to put an alert on. You have two strong levels of resistance here. Two. One, you have the 50 SMA, which you cannot seem to get through and has been trying since December 4th. That 50 SMA is at 717. But then you have a very clear horizontal price point line that starts way back at October 18th. And in fact, it kind of starts at October 15th, the bottom of it. And you draw that line across and it comes in right around 730. That fills the gap. That clears the horizontal resistance. So if you're looking at ASML, do not get tricked by a quick pop above the 50 SMA and go, all right, let's go, it's time. And I see the appeal because this stock obviously can run to 1100 in a heartbeat. But if that's the case, then you're not missing much if you wait to 730. Put an alert, let's say it's 735. 735 triggers, now you're looking at a really nice upward trade, but not until then. Have you observed a change in your analysis and how you view the market 2024 compare to a few years ago? E.g., things that worked didn't work before, works doesn't work now. Look, every market error is different. And when different, I say there are things that affect the market's levels of support and resistance, and what it would take to break through that level of support and resistance. What we've experienced since COVID is a high reliance on the Fed. Right now, you go back before 2020, 2021, the Fed was kind of an afterthought. It really wasn't much of a market mover. There were other things that moved the market. There were international concerns that moved the market. Certainly, Trump tweets moved the market 2016 to 2020, and may again going forward. But the last 4 years have been dominated by the Fed. And the market has been responding not only to what the Fed does, but to the numbers that would guide the Fed. That's unemployment, that's CPI. Nobody gave a shit about the CPI before 2020, but now all of a sudden they do. So it's just knowing with what is now driving the market, right? Soon, one day, it won't be interest rates anymore. It'll be something different. It might be an international thing. It might be the debt. But at the moment, that's what's driving it. So knowing where the market's boundaries are and what's driving the market to break through those boundaries, what's needed, has what's changed my market opinion on things. So I would be less likely to take a trade knowing the CPI is tomorrow in a day or something, or that the Fed is about to make a decision, or a Fed speaker is about to come up, particularly if it's Powell. So things like that I wouldn't even thought of before 2020 now resonate, and 4 years from now it may be something completely different. What about you, Pete?
I am cautious into 2025. That's why I'm suggesting everybody get out of their bullish swing positions. And I won't know where we stand until I see the first dip. When I have a move like this, I'm operating under the premise that this is very, very strong and that dips will be brief and shallow. If it is brief and shallow, that will present me with an opportunity to buy that dip on support and to get long and to ride that move higher. If the dip is more substantial and it's deeper and it lasts longer, that tells me that there's some selling pressure and that I need to be very cautious, and perhaps I need to even watch for a lower high double top that will roll over. In that event, then I would actually start to get bearish. Heading into 2025, all I know right now is that I am taking profits and I am going to cash. I want maximum flexibility and I want to evaluate. If you look at what I told all of you last year, I told you that you would look back at this little speed bump that we had into year end, which was right. Let's see, let's go back February 6th. This is a weekly chart. Weekly chart of 2024 was, I don't know, right in here. Okay. Look at this. Right in here. Okay. I have to laugh. Okay. This is a weekly chart. We had broken out to a new high. It was year end in here. I can't tell you how many people were screaming that the sky was falling. Oh my God. This is it. After a big run up like this into year end, there's going to be massive profit taking. What did I tell everybody? Buy more, stay long. This is huge. Ride this pony. This little tiny dip shook so many people out. We're not seeing that this year, okay? This market has run very, very far. Back in here, we had a really nice, beautiful dip in here that we could buy. We had evidence that the market was gradually starting to form some support after interest rates had been increased. So this was a buying opportunity once I saw this. And so as soon as we lifted off, I knew we were going to have a really good run. But now look at this. This is stratospheric. Valuations are really stretched. Do I pick market tops? No. Is this a good time to be in cash? Yes.
Once again, since people still are asking the question, we mentioned this at the top. The interview that we did, there were some technical problems with it, so no, that will not be unfortunately posted. We did do the interview, but there were a lot of technical issues with it, and I mean, there were some sound problems on the other side, certainly. Um, and let's see here. Uh, Deep in the money leaps. I believe I did write an article on that. It should be in the wiki. If it's not, shoot me a message on Reddit, and I will either address it next Wednesday, or I will write that article if you're looking to do fig leaps. So, and then let's see, INOD said, someone said it was mentioned in the chat room. I don't like this stock really at all. This thing just like very
On a
choppy.
compression right now.
It certainly is in a compression. You got a very long bull flag. I mean, look, again, very easy. With a stock like this, I'm going to put like, let's see, right around $50. I'll put an alert at 50. It breaks 50, which is obviously a line there for the $50 mark, but also the top of the compression. And if it breaks below, let's see, 36 on the low end of compression, then I would consider it either for a short or for a long. I certainly would consider it for a short if it re-enters the gap at the bottom of the 11.8. So I'd put a alert there at 29.50. But both of those are around $10, $12 away on the upside and downside. So until then, there's really not much one can do with it. We covered the idea of doing an event conference. Pete hates them. He said he would come if I put one on. I am still thinking of doing one in Vegas. Again, the problem is, look, it costs about, I would say $100,000 to put on a conference, right, in Vegas. So could I get 500 people to show up and pay $200 each just to break even on that? I don't know, maybe. Not just to do it and break even and have a 2 to 3 day conference. Yeah, maybe we could do that. But I would need to see I can get 500 to 1,000 people that are willing to come. The problem is you get 100 people coming. It doesn't reduce the cost of the fact that you don't get as many people doesn't exactly reduce the cost of putting on a conference. You got to rent the room in Vegas. You got to set up all the stations. You got to food. There's a million rooms. There's a million different things you have to do to put a conference on, and it costs a decent amount of money. So I would do it if there are about 500 people who are willing to come. Last I checked, there was roughly around that, so that's why I'm considering it. But Pete hates them. I think it would be fun, but I like Vegas. I think it would be fun to do, but we'll see.
It is just a tremendous amount of work, and I am telling you that you can't charge enough for these damn events because the hotels rake you over the coals. I know you want coffee and donuts. That's just astronomical what they charge.
$50 a
And
donut.
so the takeaway is like, oh, gee, Harry and Pete are making a killing on this. $1,000 to go hear them. And it's just not true because the overhead is very high, and the organization and the planning for every detail. And then you got events and syllabuses, and I've spoken at so many of these. I'm winding my career down. I don't want anything to do with them, but I would do it for you, Harry.
It would be, look, I hate speaking to people one-on-one. I love speaking to large groups of people. It would, look, it's a pain in the ass. It would, do it in Scottsdale. That's the trading capital of the world, Scottsdale, Arizona. That's where everyone would head. Yeah, we'll all go there, and then we'll head to the Denny's afterwards. The only place to do it would be Vegas, centralized. It's fun, but like I said, maybe. All right. Is there any other pertinent questions here? I'm having a hard time recognizing price compression for scalps and swings to stop your scalps. Deciding entries, could you show an example of price compression and looking for entry points? We just did on a couple of them, right? We just looked at INOD. There's a bunch of those that you can look at. Um, Compressions are generally known as bull or bear flags, usually because they usually follow a big move. And then you just set an alert on the top end and the low end. If you're bullish, you're looking at that high end alert. You want it to break through. Are there times where you can anticipate the breakthrough? Yeah, if you have a stock that looks like it has strong relative strength, it's in a compression, but on the daily chart, it looks like a good day trade. But also because it has a relative strength, you and the daily chart looks good, you could potentially swing it and you can catch that compression to the upside. But you need a bullish market, you need relative strength on the stock, and you need it to be towards the top end of the compression anyway to do that on a swing. But other than that, don't anticipate it. Set your alert, move on. There are hundreds of stocks you can just alert, 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 set alerts all the way through. And then every day they'll pop up and you can pick and choose which ones you want to make the trade on.
I think that I am going to stay consistent with what I believe right now, which is that you should be in cash. I'm not going to give you a pick this week because I don't want to review it. I don't think the market's going to do a whole lot of anything, and I'm I'm going to tell you you should be in cash. If I give you a pick, you're going to take a pick. You're going to trade the pick. I'm going to say no. I'm not. I'm being cash. See what the
I like
market
that.
does in here and
I mean,
evaluate.
I did say Google, I did say Urban. So if you are going to trade, I would trade those. But obviously, look, everyone knows I'm short SPY right now. I'm short Nvidia. I might close Nvidia if it closes above that SMA, but I agree. I don't love the market here. I mean, you have a move today. I don't love this move. In fact, if this market all of a sudden retraced and entered the gap before we go into close today, I would not be surprised. So could I be wrong? Could we both be wrong? And like Pete says, this thing just keeps on powering up. Yeah, and then you miss it. Okay, I'd rather miss it than be sitting there in a million longs and watch this thing hit back to 600. So there are times where the best trade is no trade. I agree with Pete.
Yep, we're in hand-to-hand combat, so you can find some longs, you can day trade right now while we're in kind of a holding pattern, but the intraday ranges are going to start to compress as well over the course of the next 2 weeks as we get closer and closer to Christmas. We've got a FOMC statement. So, okay, well, what does that mean? That means Monday's going to be slow, Tuesday's going to be slow, Wednesday's probably going to be slow, and then all hell is going to break loose. And we've got triple witching a week from Friday. So everything's kind of packed into this window
Yep.
from Wednesday to Friday next week. Between now and then, I think we do a whole lot of nothing. And this is a great time to, I don't know, put ornaments on your Christmas tree.
Yes. Set some alerts, study some charts, and I mean, look, it's the end of the year. Um, don't feel that urge, like it's almost like to some people, if you feel like you're in a casino but you're not gambling, so what the hell are you doing there? Then that's not the right way to look at it, right? You got to be able to, at the end of the day, say, I didn't make a trade today, and I'm good with that. In fact, that was the best move I could have made. In a casino, you're going into that casino to gamble. In a stock market, you are looking for the right opportunities. And it's almost like if you're counting cards and you don't see a deck that hits the number you need it to hit, you don't put a bet down. Well, here, if you do not see a setup that you like or price action you like, don't make the trade. Don't force your trades. Simple as that.
Yep, your trading opportunities are on a dip. They were right here, right here, right here, right here. That's when you want to be active. And by being active in these points, you're able to evaluate the dip, evaluate the dip, evaluate the dip. And if it gets really nasty like this, then you're glad that you're not long in here. You're evaluating it and thinking maybe double top. We got to see. Oh no, we rallied almost to the high. So buyers are still engaged. Now I'm still looking to buy a dip because of the depth there. I'm going to get some retracement. There we go. All right, I can be in here. And right now, how much higher can it go? We've got this upward sloping trend line here that we're going to be hitting around 615, 617, somewhere in there. I don't think we get much higher than that. And this is horribly light volume. As you can see on the chart there, look at the volume on a weekly basis. That's nice, heavy, robust volume in there. This is what we've been working with all year. This is the move I told you to get behind. Buy with both fists right in here. Look at that volume. Look at what it's doing right now. It's falling off.
Yes.
It's not what we want.
And keep in mind, and if some people, a lot of people, and Pete's already covered, what do we think going to 2025? Every election for your cycle, the market, for whatever reason, gets optimistic, right? And what they do is they go, we're going to price in all the things we like, and we're going to assume that the things we don't like doesn't happen, right? So the market's assuming that regulations are going to be pulled back, that these businesses are going to flourish, but they're also assuming that these tariff threats aren't going to be fulfilled, right? That there aren't going to be, markets don't like tariffs. So the market prices in best case scenarios, and then what happens is as time goes on, either those things pan out or they don't. And then you get this lull. When you're seeing the lull, you get this drop in volume, because now it's a wait and see, right? It's a wait and see which picks are going to come in to lead these agencies, what things are going to go through, how's Congress going to shake out, blah, blah, blah. And then things start to wait. You got this huge jump up from the election and a price in a very, very positive scenario. Now it's a wait and see, and a wait and see with the Fed. It already made clear that the Treasury nominee said, we're going to let Powell stay in his position. Okay, well, Powell said he's not going to leave the position anyway. So it's kind of an empty gesture, but fine. They're going to let Powell stay. Thank you, Powell. People like Powell. That's a good news for most people. Think that despite the earlier, inflation is transitory, he's actually had a pretty steady hand. That helps, but we'll see. Let's see. As Pete said, there's a lot of stuff coming up. Will the Fed cut rate in December? About 50-50 right now. That'll be a big determinant of how we go into the year.
Yep. So keep your powder dry. Enjoy the holidays. Don't worry, that you're not catching every move, because the moves are going to be very tiny in here. And when you have cash, you have flexibility, you see things objectively. That's really where I think you need to be right now. So that's all I've got for you. Hopefully I'll have a pick for you next Wednesday pre-Fed, and expect some really light trading action between now and then. Thank you, Harry. Thanks everyone for attending. We will see you then.
See you, everybody. Thanks.